Have you ever wondered why people who talk most about investing are not always the ones who become wealthiest? Every week another asset appears as the next golden opportunity, yet the more opportunities people chase, the more money they can lose. We are taught that great investors must move quickly, even though sometimes the better decision is simply to do nothing. Investment prices can move every second, but wealth is rarely built in seconds and usually unfolds across years. Many people do not fail because they chose a bad asset, but because they keep chasing whatever looks more attractive. Welcome to The Margin, where we examine modern life through money, investing, and the financial psychology most people rarely discuss. Today, we are looking at why boredom can become one of the biggest advantages an investor has. If you understand this simple principle, your view of investing may change more than finding the asset everyone is talking about today. Almost every investor eventually experiences shiny object syndrome, the constant urge to chase whatever looks more attractive. Today, technology stocks can feel right, tomorrow crypto can seem more promising, and next week a new asset may appear to promise everything. The more often you switch investments, the less time each one has to truly grow, even though time is the fuel behind compounding. The human brain naturally likes new things, but the market does not reward excessive curiosity. Many people mistake constant activity for progress, even though making too many decisions can increase the chance of mistakes. Investing is not a race to find the most interesting story, but a process of letting time work when we are patient enough not to interfere. The real question is not which investment is viral today, but which one can still work for you 10 years from now. Whenever an asset suddenly surges, our brain sees a rare opportunity when we may actually be watching the peak of someone else's euphoria. Social media makes it feel like everyone is making big gains, while the thousands quietly losing money rarely appear on screen. We remember success stories more easily than millions of failures, making emotional investment decisions feel more logical than they really are. The more we compare our portfolio with other people's portfolios, the harder it becomes to feel satisfied with our own strategy. Many investors do not lose money simply because the market falls, but because they panic before compounding has enough time to work. Long-term wealth often looks boring while it is being built, only appearing extraordinary years later. And this raises the biggest question. If excitement is not the answer, then what is the real secret behind investments that can survive for decades? Let's begin with the first layer of the fortress, the moat, which represents an emergency fund that exists not to make you wealthy, but to prevent rushed decisions driven by panic. An emergency fund creates space to think when life suddenly changes, and that breathing room is often more valuable than the money itself because calm decisions usually outperform rushed ones. Imagine someone losing a job during a weak economy, where an emergency fund allows time to search for the right opportunity instead of accepting the first option out of fear. This played out for millions of workers during the COVID-19 layoff wave, when those with emergency savings generally had more time before needing to sell assets or borrow money. But there is a limit that often goes unnoticed, because each passing month steadily reduces the balance while living costs and inflation never stop moving. At a certain point, the emergency fund stops feeling like protection and begins to resemble an hourglass as the shrinking balance steadily increases psychological pressure. That is why an emergency fund should not be mistaken for the entire fortress, because it is only the moat that delays incoming threats while time continues to pass. This is where we enter today's framework, the Wealth Compounding Snowball, where wealth grows like a snowball rolling downhill. The first pillar is consistency, because small investments made repeatedly can be stronger than large investments made only occasionally. The second pillar is time, which allows returns to generate new returns through the effect of compounding. Albert Einstein is often linked to the phrase about compound interest being the eighth wonder, although the attribution remains debated. The third pillar is low mistakes, because wealth can grow by avoiding bad decisions rather than always making the best ones. These three pillars reinforce one another, and losing any one of them can slow or stop the snowball from growing. Many people search for a secret formula to become wealthy, while the actual formula is so simple that it often feels boring. Ironically, an investor's biggest enemy is often not inflation or recession, but the urge to keep acting when nothing actually needs to be done. When markets fall, fear makes us want to sell, and when markets rise sharply, greed makes us want to buy even more. These emotions seem opposite, but they lead to the same outcome: decisions driven by feelings instead of strategy. During the 2008 financial crisis and the market turmoil of early 2020, many investors sold assets in panic and later missed part of the recovery. Investors who stayed with their plans could participate in the recovery without having to guess the perfect time to return, and that was discipline rather than luck. Markets will always change, but a simple, consistent system can provide a sense of calm through that volatility. The real question is not how to find the most exciting investment, but how to build a system that keeps running when emotions are unstable. Successful investors rarely wake up wondering what to buy today because they are more focused on keeping their system running with minimal intervention. A good system can outperform strong motivation because automated investing reduces the need to fight your emotions every month. Setting a regular investment schedule matters more than the amount because the habit needs to remain consistent. Checking your portfolio every day can turn hourly price changes into anxiety instead of better decisions. The things you can control include your savings rate, investment costs, and consistency, while everything else is left to time. The simpler your system is, the less likely you are to interfere with it yourself. The best investment is ultimately the one you can continue maintaining for years, rather than one that only excites you for a few weeks. Maybe we have been defining great investors incorrectly because they are not the ones who always find the biggest opportunities, but the ones who stay calm when everyone else loses direction. Wealth rarely grows from one extraordinary decision, but from hundreds of small, consistent decisions that usually look anything but exciting. The market will always offer a new story every week, while the stories that build wealth usually never become the headline. While others chase the next exciting opportunity, you can remain focused on the long term and let calmness become a competitive advantage. The Wealth Compounding Snowball reminds us that consistency, time, and fewer mistakes can matter more than strategies that depend heavily on luck. The longer you stay with a sound system, the more compounding can grow beyond what people who constantly change direction can easily catch. An investment that feels boring today may simply be building a much calmer life in the future in ways that numbers alone cannot measure. The world will keep offering investments that look faster, more exciting, and more profitable, while lasting wealth is usually built much more quietly. Do not be afraid if your strategy feels boring, because boredom can be a sign that market emotions are not controlling your decisions. The Wealth Compounding Snowball framework comes down to consistency, time, and low mistakes working together over the long term. The goal of investing is not to win this week, but to give your future self a life with less financial pressure. If this video gives you a new perspective on money and investing, subscribe to The Margin for Calm, Simple, and Reality-Based Financial Thinking. What is the most boring investment or financial habit you still follow today, and how has it changed the way you see money? Share your answer in the comments, because a simple personal experience may become a valuable lesson for someone else, and thank you for watching.